Russia is preparing to come back to the market with its first international bond issue since 2013, which is seen as a sign that low oil prices are really starting to squeeze the state finances and that falling revenues could leave Russia with a substantial budget deficit to plug this year. This is already the third measure that Russia has floated to plug that revenue gap. It has instructed ministers to cut spending by 10% and has earmarked a handful of state companies for possible further privatisations. So this is definitely evidence that the combination of sanctions and low oil prices is putting a lot of pressure on the economy. Sanctions themselves only affect a handful of companies, such as the big banks, Sberbank and VTB, and Rosneft, the oil company. They bar them from raising Western financing for a term of more than 30 days. But there's nothing actually stopping the sovereign from raising a Eurobond. In a world of low yields, trading in Russian bonds has been quite strong in recent months. Investors have also become more optimistic that sanctions could be eased this year, although there's no guarantee of that. Investors, banks and Western authorities have no control over what Russia does with the money, so it could, in theory, use it to provide financial support for sanctioned companies. Even if it isn't used directly for that, simply having more money in the coffers could free up resources from elsewhere to help support sanctioned corporates. Western governments are likely to be looking closely at this bond, but unless they impose new, deeper sanctions, there may be little they can do.